Here's a rapid-fire update on all the stocks in Jim Cramer's charitable trust, the portfolio we use for the CNBC Investment Club. Jim ran through each stock Tuesday during our December monthly meeting. Apple. In 2024, revenue from Apple's services division is poised to take center stage, which would serve as a reminder to skeptical investors how important the growth of that business has been to the stock in recent years. Next year may also be filled with chatter about Apple's new mixed reality headset. But Jim said not to expect commercial success right away, even though it's a high-quality piece of technology. Amazon. Given the online retailer's more than 80% ascent so far this year, investors may be wondering when, if ever, they'll get a chance to buy the stock on weakness. That could arrive on a day when sellers react to a headline from US antitrust regulators, pushing the stock down a few percentage points, Jim said. The opportunity also may arise during a market rotation out of standout tech winners, which we've seen from time to time this fall. In any case, here's a deeper look at our thinking around buying on weakness. Broadcom. We trimmed our positions slightly Monday after the semiconductor and software firm soared nearly 20% in a single week. Given the lack of obvious catalysts, that's what we call a parabolic move, which requires our discipline to kick in and book profits. The reasons for long-term optimism remain, including benefits from generative artificial intelligence investments and the recently closed VMware acquisition. Bausch Health. We may have to take losses in Bausch Health as soon as this year, following many months of legal uncertainty. If it was sold, we wouldn't buy it back. That fails one test for ownership in the charitable trust. Caterpillar. Big picture, Jim likes the industrial companies in our portfolio, which includes this machinery maker. The stock has had a big run lately, up about 16% in December alone, as investors grow more confident that the Federal Reserve is done hiking interest rates. Costco Wholesale. After another terrific quarter, there's not a ton else to say, except that we're grateful for the $15 special dividend that will be paid out soon, and expect to have a long, happy investment relationship with the retailer. Salesforce. The enterprise software giant is well positioned for 2024, as we expect management will remain disciplined on costs, which is good for margins. We also predict that its generative AI offerings will become the de facto way other companies embrace the much-hyped technology, which could help revenue growth re-accelerate. Cera Energy. Jim said he'd like to buy more of this stock, but it's trading pretty close to where we bought December 6, so we're holding off. We do see value in the stock below its current $26 per share. Wall Street increasingly agrees, with 3 analysts upgrading the stock to a buy last week. Dupont de Nemours. Dupont's exposure to the housing market looks better after last week's Fed meeting, when we learn the central bank expects to cut rates in 2024 more than previously thought. More important is its electronics industry exposure, where CEO Ed Breen has recently seen some green shoots. It's too cheap at current levels, Jim argued. Danaher. The payoff for our patience looms. It's been a longer than expected dry spell for Danaher, Jim acknowledged, but its setup for 2024 is encouraging amid hopes for a thawing in the initial public offering market. IPOs help Danaher's key customers in the biotech industry get the capital they need to buy Danaher's equipment. Jim said he still views Danaher as a stock worth buying. Walt Disney. The entertainment giant's stock is likely to be a grind, but there is at least a clear set of boxes CEO Bob Iger can work on crossing off. That includes free cash flow around $8 billion in 2024 and streaming profitability by the end of next year. Jim added that he'd like to see Trian's Nelson Peltz gain a seat on the company's board. Estee Lauder. The cosmetics maker is our second biggest quandary behind Bausch, a shocking reversal of fortunes for a stock that used to be best of breed. After 3 terrible quarters, it's possible the business may be turning around. However, Jim said the magnitude of the miscues combined with management's apparent failure to recognize how poorly the company is doing may render holding on to shares an exercise in futility. Eaton Corporation. This industrial joined our portfolio on the day of the November monthly meeting and has moved roughly in line with the broader market since then. We'd like to have a larger position, given the flood of Inflation Reduction Act money expected in 2024. but we're not sure the market will give us the opportunity to add below our cost basis. If we get a sell-off in January, Eaton is a logical place to look to buy, Jim said. Ford Motor. Few people seem to expect a good 2024, but Jim said it appears possible for multiple reasons tied to its dividend. First, the potential for Fed rate cuts will make Ford's dividend appear more attractive to investors. Second, Ford's decision to emphasize hybrids and spend less on unprofitable electric vehicles will help ensure the company can sustain its quarterly payout. Foot Locker. We don't want to get too positive on a retailer amid a turnaround because it reported one better-than-expected quarter, which sparked a short squeeze in the stock. However, CEO Mary Dillon's revitalization efforts may finally be starting to show up in the financial results, so we're willing to let this play out. GE Healthcare. Shares are up nearly 14% over the past 3 months, which is encouraging for the embattled name. In the new year, we expect to see more activity to establish healthcare infrastructure to support a new class of Alzheimer's therapies, as Eli Lilly's drug is expected to receive regulatory clearance. GE Healthcare, which makes MRI machines used to monitor patients on those therapies, stands to gain from the build-out. Alphabet. Of all the so-called Magnificent Seven stocks, Jim said he's most concerned with Alphabet due to Google Cloud's struggles in the company's late October quarterly report. However, because we took profits in the stock November 27th, and other areas like YouTube are performing well, Jim said he feels comfortable staying invested in the tech giant at current levels. Honeywell International. New CEO Vimal Kapur is wisely betting on secular trends around safety and security, punctuated by the firm's recent $4.95 billion deal for Carrier's security business, which makes products like electronic locks and fire alarms. Honeywell's aerospace segment continues to be strong, while we await additional portfolio moves that Kapur makes. Humana. Shares are about as cheap as they have ever been, at less than 15 times forward earnings. This suggests the stock is reflecting investor concerns about a possible uptick in hospitalizations and wariness heading into a presidential election year. Despite its recent drift lower, we're hesitant to buy on the weakness. This could be a situation where the stock is telling us something. Linde. The industrial gas giant's speculation-driven volatility last week doesn't change a thing about its exceptional fundamentals. It's one of the few industrials with a proven track record of growing in both good and economic times. We've routinely needed to hike our Linde price target, and all signs point to needing to do that again soon. Eli Lilly. Deciding when to buy Eli Lilly has been tough lately, given the stock's significant outperformance in recent years, including 2023. However, we can see buying on a potential pullback, which could materialize in the near term as investors book profits. In the new year, catalysts include the approval of Alzheimer's therapy donanemab and improved manufacturing capacity to support demand for obesity drug Zepbound and type 2 diabetes treatment Mounjaro. Meta platforms. It's been a bit quiet around for the Facebook and Instagram parent lately. Meta's digital advertising offerings, including through its TikTok competitor Reels, are highly sought after, with AI helping to boost their attractiveness. The biggest problem with Meta is its heavy spending into the money-losing Reality Labs division, though Jim said he's trusting CEO Mark Zuckerberg will not lose billions on it endlessly. Morgan Stanley. This bank stock has finally gotten the respect it deserves, jumping nearly 15% over the past month. From here, Jim said investors should pay close attention to headlines around mergers and acquisition activity. More M&A is good news for Morgan Stanley's investment banking division, and by extension, its stock. Microsoft. So much is going in Microsoft's favor right now, including a refresh cycle in the personal computer market and video games now that the Activision Blizzard acquisition is complete. But its work with pioneering AI startup OpenAI is the most exciting of all, Jim said. That extends to Microsoft's AI assistant product, called 365 Copilot, which is well on its way to becoming a significant revenue stream for the company. NVIDIA. Shares of the chipmaker currently trade at 25 times forward earnings, well below their 5-year average of roughly 39, according to FactSet. Jim said he's not sure how the premier growth company of our time can be this cheap. While this could reflect concerns about competition in the AI chip market from AMD, or the general sustainability of heavy AI investment, we still sees multiple years of hypergrowth ahead for NVIDIA. Only NVIDIA and Apple have Jim's Own It, Don't Trade It designation. Join us on Patreon, links in the description.